All right, so Coke versus Pepsi, the Cola Wars. We've all heard about it. But here's what most people don't know. Right now, one of these companies is sitting on a way better opportunity than the other. And it's probably not the one you think. Let me walk you through what I found. Because the difference between these two isn't just about which soda tastes better. It's about money, momentum, and which stock could actually make you some serious returns. So let's start with the basics. Coca-Cola, KO on the stock market, is what you'd call a pure beverage play. They make concentrates and syrups, sell them to bottlers, and let those bottlers handle all the heavy lifting. Manufacturing, packaging, distribution, none of that's Coke's problem. It's an insanely efficient model. High margins, low capital requirements, basically a money printer. PepsiCo is different. Yeah, they've got Pepsi, Mountain Dew, Gatorade, but here's the thing. More than half their revenue comes from snacks. Lay's, Doritos, Cheetos, Quaker. They're not just a beverage company. They're a food and beverage empire. And that diversification, that's actually a massive advantage when times get tough. Now here's where it gets interesting. Over the last 3 months, Pepsi stock rallied about 8%. Coke, down almost 4%. That's a 12-point swing, and it's not random. The market is telling us something. Let's talk numbers. Coca-Cola just reported their Q3 earnings, while they're about to. Wall Street expects earnings per share around 78 cents, up just 1% from last year. Revenue's supposed to grow about 5% to $12.4 billion. Solid, but not exciting. The big concern? Volume. Unit case volume dropped 1% in Q2. That means fewer people are buying Coke products. They're making up for it with price increases, 6% in the second quarter, but that only works for so long. Eventually, people stop buying when prices get too high. PepsiCo already reported their Q3 results, and they beat expectations. Earnings came in at $2.29 per share versus the $2.26 analysts expected. Revenue topped forecasts too. Now, their organic revenue only grew 1.3% and volumes were down 3%. Not amazing, but here's the key. The market liked it because it showed stabilization. Management said service levels improved, international business bounced back in September. It was a signal that their turnaround is working. You see where this is going? Coke is the more profitable business on paper. Their gross margin is 61%. Operating margin over 30%. Return on equity in the mid-40s. Those are world-class numbers. Pepsi's margins are lower, 55% gross, 15% operating, because snacks and bottling operations are just less profitable than selling syrup. But here's the thing. The market already knows Coke is high quality. That's why you're paying a premium for it. Coke trades at a forward PE of about 22 times earnings. Pepsi, around 18 times. That's a meaningful discount. And when you're investing, you don't just want quality. You want value. You want to buy something good at a fair price, not something great at an expensive price. Now let's talk dividends, because both of these companies are dividend royalty. Coke has raised its dividend for 64 straight years. Pepsi for 54 years. They're both dividend kings. But Pepsi's dividend yield right now is 3.7%. Coke's is 3%. That's 70 basis points more income just for owning Pepsi. If you're retired or living off dividends, that difference matters. Here's another piece most people miss. Pepsi has catalysts, real near-term reasons the stock could move higher. They just hired a new CFO from Walmart, someone who knows how to cut costs and run operations efficiently. They've got an activist investor, Elliott Management, pushing them to unlock value. Activists are like that friend who tells you to finally clean your garage. They force change, and the market loves that. Pepsi also strengthened their partnership with Celsius, the energy drink company. Energy drinks are growing way faster than soda. That's smart positioning. Meanwhile, Coke's big catalyst is maybe spinning off their Indian bottling unit in an IPO. Could be worth $1 billion. That's nice, but it's not happening tomorrow. Let me hit you with the technical side real quick. I know, charts can feel like voodoo. But they matter, because they show you what the crowd is thinking. Coke's chart? Not great. The stock's been stuck in a falling trend channel. That means every time it tries to rally, sellers show up. It's trading below its 200-day moving average, which is a bearish signal. There's support around 64 bucks and resistance near 74. It's just sitting there, going nowhere. Pepsi's chart is the opposite. The stock just broke out of a downtrend. It formed what's called an inverse head and shoulders pattern. That's one of the most reliable bullish signals in technical analysis. The breakout happened around $152, and the measured target is $182. Volume is strong on the upside, weak on the downside. That's accumulation. Big money is buying. So we've got Pepsi with better value, higher yield, activist pressure, bullish technicals, and momentum from beating earnings. And we've got Coke with better margins, a premium valuation, and some volume concerns. Which one would you rather own right now? Now, I'm not saying Coke is a bad stock. It's not. It's a phenomenal company. If you already own it, keep it. It's a core holding. It's the definition of a sleep-at-night investment. But if you're deciding where to put new money today, Pepsi looks like the smarter play. The market is pricing Coke for perfection. Any hiccup, more volume softness, a currency headwind, a miss on earnings, and that premium multiple could compress fast. Pepsi, on the other hand, is priced for skepticism. The market doesn't fully believe in the turnaround yet. That creates opportunity, because when companies underpromise and overdeliver, the stock rips higher. Let me give you an analogy. Buying Coke right now is like buying a Mercedes at full price. Yeah, it's a Mercedes. It's beautiful, but you're paying sticker. Buying Pepsi is like finding that same Mercedes at a 20% discount because it needs a detail and an oil change. You fix those little things, and suddenly you've got a steal. One more thing. Both companies face risks. Consumer preferences are shifting away from sugary drinks. That's a long-term headwind. Both rely on price increases to drive growth, and there's a limit to how much more expensive a Coke or a bag of Doritos can get before people just stop buying. Currency fluctuations hurt both of them since they make tons of money overseas, and regulations, sugar taxes, plastic packaging rules could hit margins. But here's why Pepsi handles those risks better. The snacks business is more resilient. People will always buy chips. Even in a recession, a bag of Lay's is a cheap indulgence. And with over half their revenue coming from food, Pepsi doesn't live or die by soda trends the way Coke does. That diversification is a cushion. Wall Street sees this too. The average price target for Coke is around $77.50. That's about 14% upside from where it's trading now. Pepsi's average target is $155, which is basically flat from here. But several analysts just raised their targets after earnings. UBS has it at $172. If the turnaround gains momentum, that consensus could move higher fast. So here's my takeaway. Coke is the better business on fundamentals. Higher margins, better returns, stronger brand. But Pepsi is the better investment right now. Better value, better yield, better catalysts, better momentum. And in the market, timing matters. You don't just want the best company, you want the best company at the right price, at the right time. If I had to pick one to buy today, it's Pepsi. Not because Coke is bad, but because Pepsi gives you more ways to win. You get paid more to wait with that higher dividend. You get the potential for multiple expansion as the turnaround story plays out. And you get the technical tailwind of a stock that just broke out. So yeah, while everyone's debating whether Coke tastes better than Pepsi, the real question is which one makes you more money? And right now, the answer is Pepsi. And hey, I hope this video helps you on your quest for profits. Catch you on the next one.